6 undervalued dividend stocks near their 52-week lows. As always, on this weekly episode, we're going to analyze each company's historical performance. We'll take a deep dive into their dividend safety. We're going to look at their supporting financial metrics. And as always, we will run each company through the valuation model. We want to get to their intrinsic value. We want to find their acceptable buy price given our investor margin of safety. And we will see what are Wall Street having as their price target over the next 12 months to see if they indicate this as a strong buy now. So jumping into our first undervalued dividend stock, we have Nike. Now this is one that has been pummeled down 27% just over the last 12 months. When we look over the last 10 years, however, this is a stock that is up 152%. Do bear in mind this doesn't include dividends reinvested, so that would take this number slightly higher. And we can see all-time highs sitting around $178 in November 2021. As we mentioned, right there now trading at its exact 52-week low. It does have a forward yield of 1.7% and a forward P sitting at 24.01. Now, when we take a look at the metrics, we can straight away see 99 on that dividend safety score. Very safe, the safest score that you could obtain through this system. And the market cap does sit at 134 billion. So we are talking about a mega cap company. Now, recessionary metrics. So in the last recession, they increased the dividend. Remember, this was during 2007 to 2009. Whilst they had negative 6.6% recession sales, this was above the average growth, the S&P coming in at negative 12%, and they also actually beat them on a recession return, negative 36, with the S&P returning negative 55 during the same time period. One thing that I do quite like about this company as a dividend growth investor, we can see 8.8% increase to that dividend last November, double digits over the last 5 years, double digits over the last 20 years, a very strong company in terms of increasing those dividends to shareholders. And whilst they have been increasing those dividends for the last 21 years consecutively, they are now 4 years away from becoming a dividend aristocrat, and they've been paying a dividend for the last 39 without reducing it. Now, for those that are new to this channel, essentially dividend yield theory, it states a company is undervalued when the current yield sits above the 5-year average. As we can see here, this would be our first sign of undervaluation, 1.67 above 1.02. And also, what is quite interesting to note right now with this yield, it is the highest yield that they have offered over the last 5 years. We also see another strong undervaluation signal with the forward P sitting at 23 below 31.9. And when we do take a look at the consumer discretionary at 13.8, the sector P does sit much lower, even though Nike has reduced significantly to 23. Now, talking about dividend yield theory as well, we have in fact released our latest free weekly article. We run through dividend yield theory, we talk about undervalued dividend stocks, and we do mention 10 for you to consider for your portfolio. If you want to grab a copy of this or look at any of our other articles, it is all completely free. All you need to do is click on that pinned comment below. Moving back then to the metrics, what we can note when we do take a look at the free cash flow payout is that when we want below 60%, because essentially that means and gives us faith that management can offer those double-digit dividend increases that we love to see with this company. Over the last 10 years, and Nike has done exactly that, bar 2020 where they did struggle as we see the triple digits. 2022, 2023, 42%, 2024 expected 33%. So we can see that dividend does look to be very safe based on this free cash flow payout. And for those that are new, whilst we do have the earnings data available on screen, we do tend to go over that just because it is susceptible to manipulation by management through accounting. Free cash flow per share then. One thing I like about looking at companies is seeing increasing free cash flows year on year. What's good about this company is, yes, we do know the inconsistencies. It isn't growth every year, but it moves in the right direction. It is increasing over the longer term. $3.14 in 2023, expected to go even higher in 2024 to $4.49. So that is very attractive to see as a potential investor. Sales growth, when we do our deep dives, we do look at the top line revenue increases or decreases over the last 5 to 10 years. We strive for 3 to 7% in the companies we want to select, to review, or even to buy. Nike, every single year they have done around that 3 to 7%, if not better, bar 2020 where it was that pandemic year. So that is justifiable, so no worries with their top line. And when we look at it numerically, they have nearly doubled that over the last 10 years. What they also do is return some of that excess cash through share buybacks, 1.81 billion in 2014, coming down to 1.54 in the latest quarter. So again, very nice to note when you do consider they also offer some nice dividend increases year on year. ROIC, now this is one of my 7 golden dividend metrics. I personally want to see 10% or more. Gives me faith management are able to effectively allocate their capital. Whilst we do see this drop down year on year, still 21, 22% over the last 2 years is well above the 10% that I like to see. And even in their worst year in COVID, it dropped to 14%. Still looks very strong and very healthy. Now, in terms of margins, both operating and free cash flow, they seem to be doing fairly well. Above 12% on the operating side. It does straddle around that every single year, at least 12 at a bare minimum that we saw in 2023. Now, in terms of the free cash flow, a little bit better as it is continually above the 5%, bar that essential COVID year. 10% over the last 10, or in fact over the last 2 years, 22-23, is very healthy. Now, one of my favorite metrics to look at, especially when you are considering dividend safety, is the net debt to EBITDA, the earnings before the interest, tax, depreciation, amortization. This correlates to dividend safety as well as balance sheet strength. We want to see below 3 as a blanket rule again. This gives us faith, as we can see, in terms of the number of years it would take the management to pay off their debt net of cash on hand. 2023 at 0.19, 2024 at 0.18. Not really that many days or months for them to pay it all off. No worries, well below the 3, so we can see both balance sheet and dividend safety is looking very strong. Now, as always, if you are enjoying the content and value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, what we're going to do is typically on the channel with these reviews, we do run through and do a deep dive of every single model. For today's episode, let's get straight into the intrinsic value calculation, and it is the average of these 3 models that you do see on screen. Today's episode for NKE, we're getting an intrinsic value of $102. Now, for those that are new, we start off with a margin of safety of 10% and we execute on that if we believe it meets 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. So at 10%, we believe a buy up to $92. At 15%, it isn't too far off. We're talking around $1 or $2. So we would say it's leaning towards a 15% MOS level based on our current analysis. Although we do want to point out that for a lot of these models, we have been fairly conservative. So we do feel satisfied in calling this a company with a 15% MOS. In terms of Wall Street and their forecasts, well, they don't agree with us. In fact, they believe the intrinsic value is higher given they see the share price going to $115 over the next 12 months. They believe this company is a very strong buy now with 29% upside over the 12-month period. And as always, as we go along these stocks, do let us know your thoughts in the comments below if you are buying any of these or adding these to your watch list. The next undervalued stock that we are analyzing is the Hershey company, ticker symbol HSY. Again, plummeted down over the last 12 months, down 25%, trading right there near its 52-week lows. One of the issues with this company is the cocoa prices that continues to increase over the last few years, really damaging their share price as well as their margins in terms of their cost versus their revenue. Now, when we take a look at the performance over the last 10 years, they are still up just under 100%, and we do note they did fall very sharply from their all-time highs of $275 just about a year ago. In terms of the yield, it is reaching now towards that 3% starting level, and the forward P does sit around that 20 level at 20.16. Dividend safety, similar to Nike, we have a very safe score of 93, a market cap of just under 40 billion, making this a large cap company. Now, last recession, what happened? They didn't cut the dividend. They also didn't increase it. They surely maintained it. They had pretty much flat recession sales, but again, remember, above average growth. And they also beat the S&P with their negative 30% return. In terms of dividend growth, well, this is one that I do hold in my portfolio, and one of the reasons we can see we love it as a dividend growth investor. Double-digit increase to their dividend literally just a few months ago. Double digits over the last 5 years, and pretty consistently, nice to know, over the last 20 years, as well as that 10% year on year. Now, they do lack a little bit, only 14 years of consecutive increases, but we do note they do like to pay a dividend with 94 years of paying that without a reduction. Now, in terms of dividend yield theory, we have another sign of undervaluation, both on the yield and on the forward P, so that double sign right there off the bat, and it is one of the highest yields they have offered over the last 5 years. In terms of the sector P, pretty much spot on with consumer staples coming in at 20.2. terms of the payout ratio, well, what we see here, if you want to expand and look purely at just the sectors, consumer staples at 70%, Hershey's hasn't in fact hit over that other than 2014, and in fact for the majority of the last 10 years below 60%, although we do note 2024 is expected to hit 24%. In terms of the free cash flow per share growth, well, very nice increases over the larger term. We do see year-on-year increases for the large part, although we do see some years where it does fall slightly. Positive to note, 2024, even with the issues in the cocoa prices rising, they are expecting a free cash flow increase. In terms of sales growth, well, again, around the 3 to 7% over the longer term, but we do want to point out the last 3 years has seen some very nice growth from this company, and numerically speaking, they have grown from around 7.4 billion to 11.2. Now, they do share buybacks, although very marginally, very little year on year. As we can see, they have bought back around 15 or in fact 19 million worth of shares over the last 10 years. In terms of ROIC, very strong. Yes, again, we do note similar to the previous stock, it does decrease over the longer term, but the fact over the last 5 years they have hit around the mid-20s is very strong, and again, this will be very attractive to investors who are looking at this, not just current shareholders, but also those who consider themselves potential shareholders of this company. Operating margin, not only are there no issues with meeting the target of 16% more, but operational efficiency is noted with the margins increasing over the longer term, and the free cash flow margin a fairly similar story, very healthy at that 14% in 2023. Net debt to EBITDA, something that we do know with a lot of these companies that are very strong, they do have very low net debt to EBITDA levels, and for consumer staples we increased this to 4 as opposed to 3, 1.49 in 2023, expected there or thereabouts in 2024. Again, no real worries with this company in terms of that dividend, and we should be aware of that given the fact that they just recently increased the dividend by double digits. So what about the valuation of this company? And don't forget, you can grab a copy of this model if you like in the pinned comments below, where you can run your own companies through this model to get to your own intrinsic value, your own acceptable buy price of companies in your portfolio or even those on your watch list. So with an intrinsic value of $217, a margin of safety of 10%, a buy up to 196, at 15%, it isn't quite there yet. So for Hershey, today's episode, we see a 10 to 15% MOS level. How about Wall Street? Well, they see some nice upside of 16%, whilst they do note the cocoa production and the increases in the price damaging Hershey over the last year. We do see they do believe the share price will go up to $225, $26 over the next 12 months, indicating, similar to Nike, a strong buy for this company. We then move on to the next company, which is Apple Incorporated. Now, very marginal growth over the last 12 months. We see 3.5%, although when we look at the last 10 years, very strong, up 811%. And we see its all-time highs at the 52-week range of just under $200, trading towards its 52-week lows with a marginal yield of 0.57% and a forward PE of just under 26. Now, in terms of the dividend safety, again, a third very safe score of 99, the highest score obtainable, a very mega cap company at 2.62 trillion, and we do note that they only recently started to pay dividends, so none was paid out in 07-09. They had plus 14% recession sales, although they did hit a very poor return at negative 50%. Dividend growth, not the greatest, as we do mention last May. In fact, it was pretty much in line with the average US inflation at 4.3%. We are expecting an increase over the next few weeks, so something to keep your eye on. Over the last 5 years, 7%. Over the last 10 years, 9%. Again, not the greatest, but again, you could argue holding this company should be nothing to do with the yield and more the increase in the share price return. Increases for the dividend, well, 11 years of consecutive increases, as we can see. In terms of dividend yield theory, well, we do note pretty much reasonable valuation now for this company with the yield not too far off the 5-year average. Forward P, again, pretty much in line with the 5-year average, just under 1 difference. In terms of the sector P, now interestingly, we can see the information technology sector P is now higher than Apple at 26.5. No real worries to note with their free cash flow payout. In fact, we note it has been decreasing over the last 10 years, indicating they have a lot of room this month, or in fact next month, to increase that dividend to double digits, as many shareholders would like to see. 2024, if they make no difference, it will sit around 14%. In Taking a look at the free cash flow payout, the main thing for this company is to continually increase their free cash flow year on year. We do note some years we do see drops or where it is flat, like 2016 to 2017, but over the longer term they have more than 3 times that initial free cash flow from 2014. 2024 expected to go even higher. How about sales growth? Well, this is a worry that a lot of people are seeing with this company. Where are they going to find the next large growth spurt like we saw in 2015 and 2021? As we can see, 2023, a very poor year at negative 3%. Something a few years ago you may not would have think possible for a company like Apple. Numerically speaking then, more than doubled their top line, 183 billion to 383. One thing that shareholders love about this company is that share buybacks. As we can see, they have bought a lot of these, 24.5 billion, bringing it down to 15.7, nearly 10 billion worth of shares being bought back over the last 10 years. ROIC, very strong, as we can see. One of the reasons perhaps why they don't pay a lot out in dividends, as they do have a very high rate on that return on the invested capital. In the low 60s in 2023, very strong, and very few companies that we have reviewed on that channel that can hit those numbers. Operating margin, no worries whatsoever, clear enough to see at 30% over the last 3 years. Again, free cash flow, very consistent, very strong. This is one thing we like to see in metrics as a general, when it is a very strong number for that metric and it is very consistent. Again, similar like the 2 previous companies, the net debt to EBITDA incredibly low, in fact below 1 every single year, expected to go even lower in 2024. No worries with their dividend, no worries with that essential balance sheet strength. Now, in terms of the valuation, this is one area that a lot of investors are interested in. Will this generate the returns that they have seen in the past? $210. Now, when we take a look at the margin of safety, 10% indicating a buy up to 189, 15% up to 179, and 20% pretty much under $1 difference. So for Apple, something you may not have heard before or been a long time, margin of safety does sit at that 20% level. In terms of the share price, well, Wall Street forecasts a little bit lower than our intrinsic value, but they see double-digit strong growth, 20% on that share price over the next year, up to $203. The only times where people may look at this and say, whilst it does have a lot of potential to increase over the next few years, is that if they do hold a large amount of their portfolio in ETFs, they may believe that this is one that they don't need to add, as a lot of ETFs do hold a fair significant portion of Apple within that. The next stock that we are taking a look at is McDonald's Corporation. Now, we can see over the last year, down 5.5%, over the last 10 years, up 172%, trading towards its 52-week low. We do see a yield of 2.5%, a forward PE sitting around 21.5. Now, in terms of dividend safety, 77, not very safe like the others, but still safe with that score. Market cap 193 billion. It is a mega cap company. Now, key metrics, well, look, they increased the dividend during the last recession. They had above average growth, and they had what quite possibly be in the top 5 stocks we have reviewed on the channel in terms of recession return. So if you do believe in historical performance in the recession, you do see one coming soon, then this could be a good place to consider investing in your hard-earned money. Dividend growth, 10% just last October, 8% over the last 5 years, strong double digits over the last 20 years. It is nice in terms of that dividend growth for this company, and they are 3 years away from becoming ultimately a dividend king, as they currently are a dividend aristocrat. In terms of dividend yield theory, undervaluation now, both on the yield as well as the forward PE, 21.5, and we can also see it is slightly higher, or in fact significantly higher, than consumer discretionary at 13.8. Free cash flow payout now below 50% for restaurants. My own blanket rule at 60%. They have been above that every single year, which is a bit of a shame. The only positive is it does look like it is decreasing. 63% in 2023, expected to go lower in 2024. So it is moving in the right direction. So no real red flag indicators so far. Free cash flow, again, important to note with companies you are investing in that it does increase at a bare minimum, and we can see they have more than doubled over the last 10 years, expected to go much higher in 2024 as well. In terms of sales growth, well, they have had significant periods of down to their negative 2%, -7%. We see this consistently up to 2018 and that COVID year. Whilst they did rebound very strongly in 2021, they did follow a flat year. So something just to consider with where their top line could go. Now they are looking to open, or in fact have opened, a few branches of those new stores that are looking to combat the Starbucks type of drinks, as well as those breakfast types of food. So it will be interesting to see how that affects their top line growth over the next few quarters and in their full annual report. Total sales numerically, then, you can see it has looked very, very rocky, decreasing down to 19 billion in 2020 and then rebounding nicely into 2023. Shares outstanding, they also do a fair amount of share buybacks, as we can note over the last 10 years. ROIC looking healthy, last 3 years consistently around the low 20s. Again, as I mentioned, minimum 10%, and if you want to be restaurant specific at 12%, this company is doing a very strong job at this metric. Margins, this is something I love to see. Not only in 2014 was 29% very strong and healthy, but when we look at 2023, the operational efficiency, it has increased over the period. So this is something you should not shy away from. And we can see a very similar story when we look at the free cash flow margin. 15% very healthy in 2014. It has increased very nicely. In fact, nearly doubled percentage-wise to 29% in 2023. Net debt to EBITDA, probably one of the reasons why we don't see a very safe dividend score on this company. We can see below 3.5 for restaurants. They have had a few years where it has been above that COVID year as well as 2022. Now, what I do like about this is that they are forecasting 3 for 2024. So again, it is moving in the right direction. As this starts to come down, that dividend safety will look a lot better. Nonetheless, no red flags with this company or any red flag indicators. So jumping into the intrinsic value for today's episode, we are getting a price of $319. Now this does look to be a large margin of safety at 10%, a buy up to 287. At 20%, we can see not quite there yet. So we see between 15 to 20% of an MOS level for MCD in today's current value of $266. Now, look at this. Wall Street believe the share price is going to go higher than our intrinsic value. They see upside of 21%. They do see this as a very strong buy now, and one that they do believe should be in everyone's portfolio. Don't forget, as we are going through these, to let us know your thoughts in the comments below. The next stock that we are analyzing is Zoetis. Now, this is one that we haven't actually reviewed on the channel, but it looks to be a very strong one. In fact, one of the best ones of the stocks we are analyzing today. It is down 1% over the last 12 months. Over the last 10 years, a strong performance, up 493%. All-time highs around $240 level at the back end of 2021. It is trading near its 52-week low with a yield of just over 1% and a forward P of below 29. Dividend safety, well, safe 74, again similar to the previous stock. Market cap 76 billion, a large cap company. Those recessionary metrics, well, we do have information that they did smash those recession sales of negative, or in fact plus, I should say, 30%. Dividend growth, now let me know in the comments below if there is anything more beautiful than seeing these lovely numbers. Double-digit growth December 23, strong double-digit growth over the last 5 years. And imagine that, every single year that you've been holding this over the last 10 years, the dividend has increased by 23%. Lovely to note, and they have been increasing those dividends for the last 10 years. Now, dividend yield theory, we can see a double sign of undervaluation. The yield, in fact, one of the highest yields offered over the last 5 years, and the forward P at 28.6, lower than the 5-year average, but we do note much higher than healthcare sector at 16.4. So let's take a look at the free cash flow payout. No worries whatsoever, below 60% every single year. In fact, 36% in 2024. I would be shocked if we don't see another double-digit increase to this company's dividend. Free cash flow payout increasing more than 3 times over the last 10 years. Inconsistent, nonetheless, still increasing. 2024 expected to be an incredibly strong year. And when we analyze their sales growth, very nice to know, only 1 year where they had a poor revenue increase, which was essentially flat in 2015. Since then, very healthy within those 3 to 7% baseline numbers that we target. And we can see they have nearly doubled their top line over the last 10 years. On top of that, they haven't done a lot of share buybacks, but they are still reducing the share count over time, as we can see, reducing it by around 40 million over the last 10 years. ROIC, very strong, very consistent. Remember, when you are looking at companies, try and look at companies, add them to your watch list where you see consistent metrics that are very strong and very healthy. This is one just to note, a very nice ROIC, consistently around the low to mid-20s. Operating margin as well. This is when you know a company is very strong, not only when their starting operating margin is very high, but when we see operational efficiency increasing over the last 10 years. On top of that, the free cash flow margin, very healthy. In fact, 19% in 2023 is very strong, considering that their highs of 25 not too long ago as well. Net debt to EBITDA, 1.27 in 2023, 1.2 in 2024. Again, a very strong company in terms of that balance sheet strength. Although we haven't done a deep dive, we can say just generally speaking as a high level overview. And the dividend does also look to be safe. Now, what about the intrinsic value? Well, for today's episode, we do look to have a very strong company, and the intrinsic value sits at around $211. Now, margin of safety at 10%, we see a buy up to 190. At 20%, 168, not too far off, so you have a few dollars gap, but we do see a 20% MOS level for this very strong company that we have analyzed today and for the first time on the channel. If you do want us to do a deeper dive of this company, do let us know below. In terms of Wall Street, well, they see some incredible upside to this company, 37% over the next 12 months with a forecast of 227, making this so far the highest upside company we have reviewed today. We then move on to the next stock, which is UPS, United Parcel Service. Now down 20% over the last year. When you look at it over the last 10 years, it is up 56%. Not great over a 10-year period, but let's take a look and see what is in store for the next 12 months. We do see all-time highs at the beginning of 2022 at around $225. And we do note it does have a high yield of 4.31% and a forward PE of 18.49. Dividend safety, well, 69, safe, market cap 129 billion, a mega cap company. And we do know in the last recession, they in fact maintained the dividend. They had negative 12% sales, so pretty much bang on average. And they did just marginally beat the S&P with their negative 48% return. Dividend growth, I mean, when you ignore the latest increase, you look last 12% over the last 5 years, double digit over the last 20 years. It is a very strong dividend growth company. To then see a below 1% would have broken a lot of hearts of those dividend investors in the community. 0.6, very, very poor, well below the minimum 4% we advocate on the channel. And they are doing that just to continue their increase of their dividends of 14 years. And we do see 25 years of paying without a reduction. Now, in terms of dividend yield theory, well, we have a sign of undervaluation on the yield at 4.31, although we do know over the last 5 years, they have had a little bit higher on that towards the 4.8% range. Forward P also slightly higher than the 5-year average, although we do note it is marginally lower than industrials at 19.9. Free cash flow payout, well, this is why we did see that essential increase of 0.6%. Now, this is why we always say on the channel, it is important to understand earnings data. Whilst you can use it, I would advise you to focus on the free cash flow. If you had seen this, you would have seen the red signals in terms of the payout ratio. 110% in 2023 indicates that management paid out more in dividends than they generated in free cash flow. 2024 is expected to come down, but still pretty high. So I would say unless major things happen or change, that their dividend increase over the next year may not be as high as you would like. Free cash flow per share, however, it is increasing over the longer term to 591 from 371, but a lot of inconsistencies year on year. Nice to note, 2024, they are expecting an increase to their free cash flow. Sales growth, again, up to 2022, looking not too bad, healthy, around the 3 to 7%. We do know a fairly large drop in 2023. And numerically speaking, though, we do see they have nearly doubled their top line from 58 billion to 91. They also do some share buybacks, again, marginally, not massive amounts, from 924 down to 860. Probably the one with the best share buybacks that we have noted in today's episode was Apple with a significant number. ROIC also, even though it is downtrending, as I said, just because metrics are downtrending, if they are still very healthy over the more recent period, as we can see here, it isn't a red flag indicator, and 20% in 2023 is still fairly healthy. In terms of the operating margin, it is essentially generally around the 12% level year on year, 11% in 2023, something just to keep an eye on, but again, no real red flag indicators, and the same can be said for the free cash flow margin, 6% in the latest year, but again, remember, different companies, you should have different expectations. You wouldn't necessarily have the same expectations of this company as you would a company like Apple. Net debt to EBITDA below 3, very strong. They do have a fairly decent balance sheet, 1.58, 1.59 expected in 2024. But we would say just be wary that that dividend doesn't look like it will increase massively next year either. Now, in terms of the valuation, and don't forget, if you want to grab a copy of this model, you can by clicking on the pinned comment below. You can run your own companies through and copy exactly what we are doing with your own numbers if you want to change them. Margin of safety then for UPS at 10%. We do see a buy up to 153. At 15%, it isn't quite there yet, so we see around a 10 to 15% MOS level for this company on today's price. In terms of Wall Street and their forecast, well, they see some nice upside of 11%, maybe the lowest of those we have analysed today, but they do see the share price going to $167, whilst you are looking at a fairly nice forward yield. As always, do let us know your thoughts in the comments below. Are you adding to any of these stocks? Maybe you're putting them on the watch list. What did you think of Zoetis today, ticker symbol ZTS, which was the first time we've analysed it? It did look very strong as well to consider for the portfolio. As always, if you have enjoyed the content, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. And as always, we'll see you all on the next one.